Welcome, everybody, to our Bay Area Housing Market Town Hall. Before we start, reminding everybody to subscribe to our YouTube channel, or you can go directly to our website, halengroup.com/HG-TV, and you'll find all of our videos on there as well. Now, today, we are going to be talking about current housing market stats and offer status as usual. As you all know that we have the pricing and rates projections that we share with you and the inflation rate, interest rate hikes. And we're going to talk a little bit about housing demand and versus supply and what does it mean and how are they going to affect our housing market today. It's not only about residential, but we also want to look into the commercial real estate market as well. In the Bay Area, let's start off with knowing today, a lot of companies have started their first day going back to work. I know Apple just went back to work today. It's a mandatory going back to work for 1 day a week for the next couple of weeks. Then they're going to move towards 2 days a week. And then they're going to try out permanently for 3 days a week. And Google employees as well have started that. And then you definitely see the traffic now on the road. It's interesting that this survey is saying that right now, a lot of people are still only, not going back to work. They're working at home, and maybe about 10% of the people are working about 3 to 4 days a week. But after the pandemic, you see that there's a large portion of the people actually decided to go back to work about 3 days a week instead. So I know that there are a lot of debate right now. One half of the employees, they said they really want to go back to work. They cannot work from home. And then the other bucket of people saying no, I wanted to work from home because I can save so much time. And I kind of jokingly said that one half just cannot handle their spouses and kids at home. Maybe the other half just I love being my family. So I don't know. I've been working from home for the last 16 years, so I do enjoy working at home. But because I had to raise 3 little kids as well, so I would be cooking and working at the same time. I think it really depends on your profession, right? A lot of these engineers, they really have to be in the office and then, collaborate with other coworkers. I think this is really going to be a new working habits now. You don't have to be at work 5 days a week. I think the 2-3 days a week is a really good model. A hybrid model makes the most sense for people. In the sense, it's better for the environment as well. There's not as much traffic on the road. And I hope this is going to last, that we're going to work 2-3 days. But also just because of the fact that this is going to be a hybrid model, I think before we were talking about how so many people, they're willing to maybe move to somewhere a lot cheaper because they don't have to go to work. But now with 2-3 days, you can live far away. I don't think far away meaning another state. You probably still need to be within an hour or two driving distance, right? Otherwise, it'll be way too much. So in the Bay Area, especially, we do see a lot more people coming back. We do see rental market has come up. So we're going to go into more statistics about that as well. As a matter of fact, I want to bring up one more point is that I just came back from this CSAM conference. A lot of people nationwide, they ask me, it's is it true that a lot of people from California are leaving? So do you guys see less demand for housing? I'm just far from the truth. And we're going to take a look at the numbers right now. All right, so let's take a look at Santa Clara County first. And as you see these for residential market, a lot of people have been asking, is the inventory going to go up? Usually the inventory kind of started to come up or at the most for the year around April, May, and June. As you see that for this year, April, we're almost the same level as last year, April timeframe. So we are going to be hovering probably around the same amount, or I'm predicting it's going to be a little bit more than last year, just because of the fact that a lot of sellers, they do feel maybe if I want to sell, I really should sell now because the price has gone up quite a bit. In terms of sales price over asking price, you really have to be super aggressive in order to win. This is for March, average on 15% over asking price in order to win your bid. As for the median sales price for Santa Clara County, it has reached $1.9 million, almost $2 million for single family. And as for condominium and townhouse, the median sales price has gone over $1 million as well. Again, it's a very scary number for the rest of the country, but it is pretty common. So when we have clients asking us hey, we have $1 million budget, we want to buy a single family, sadly to say that it's really hard to find any single family within $1 million budget. And in terms of days on the market, as you see that last year, it was about 10 days on the market. It has come down to 7 days on the market. I thought it would be cool to see the days on the market in terms of the price point. You would think that lower price point should sell a lot faster, But no, lower price point, actually, it takes longer to sell, while even all the way to $5 million homes, only a week on the market. And this is in Santa Clara County. And it kind of creeped up when it goes over $5 million. San Mateo County is the same thing. It's exactly the same as last year inventory level, number of new listing, 763, exactly the same number as last year, March. And then we're going to start seeing again in April, May, June, and July, we're probably going to see a little bit more inventory. And as for how competitive you have to be, it needs to be about 13% over asking in order to win your bid. And what about median sales price for single family? Historically, usually San Mateo County has a much, much higher median sales price compared to Santa Clara County. And they are right now at over $2 million, $2,040,000. I'm just surprised. I'm pointing this out. I'm just kind of surprised it's not that far off from Santa Clara County. And as for condo and townhouse, it actually is lower compared to Santa Clara County. It's under $1 million at $935,000. And so days on the market is about 8 days on the market, while as you see, again, lower price point. I don't really know what is this $200,000 to $400,000 property, unless it's mobile home, but I did not include mobile home here supposedly. But anyhow, so it's 80 days on the market. But again, as you see that the higher price point actually does not discourage people from buying. Actually, it's only 6 days on the market for even $5 million and up purchase price. What about Alameda County? The number of listings is also very similar to last year around the same time, and it needs to be 17%, even more competitive than Santa Clara and also San Mateo County. And in terms of median sales price, for single family is about $1.4 million. And for condo and townhomes is about $775,000. It's only 8 days on the market for Alameda County. This is across all three counties. Lower price point, it takes much longer to sell. And then when you are between about like 1.4 to $1.6 million range, is pretty normal. Even for $5 million plus, only 4 days on the market. So this is really interesting to see, because I think a lot of people say like, oh, if it's like really expensive home, it takes longer to sell. In the Bay Area, it doesn't look that way at all. The last 30 days, our team had made some of the offers that we have made. And then I think if you have been watching our webinars, you might notice something, is that we see a lot more single digit numbers this month. This last 30 days. Usually it's all double-digit numbers in terms of number of offers. However, the amounts that they're accepting is still quite a bit higher than their asking price. Just because they don't have a lot of offers, people are still relatively aggressive. Doesn't mean that people are not really making very aggressive offers. For example, if you look at this property, 2.85, we received a preemptive offer. It still went over about 10% over asking price. And for this one in Santa Clara City, asking price 1.5, received 9 offers and went over $2.05 million. So it's a huge price jump still. And Dublin for East Bay, $1.2 million asking price and had gone up to 1.558. So people are still pretty aggressive, but you do see number of buyers are less. And we can go into a little bit more discussion why that is. And there is definitely something to do with the interest rate. Speaking of interest rate, some people think that because of the rising interest rate, the home price is probably going to come down. These are just some of the projections from some of these organizations and agencies have predicted for the home price forecast for 2022. On average, is about 6.7% increase in the home price still. So nobody is predicting that the home price is going to crash in 2022, despite the interest rate hikes. One of the main reasons we had talked about is that no matter what, supply and demand is still very low. Demand is still very high. And one of the reasons why the supply is very low is because the construction is just not there. We are not including in here about why the construction is not building, but in the previous webinars, we have looked at the construction cost, regulations, the impact fees, development fees is really high right now. So a lot of developers, as a matter of fact, when I went to the CSAM conference, I've met some developers and they've told me that, hey, we have 3 deals under contract and we canceled them because we realized the construction cost is way too high and they had forfeited their earnest money deposit. They don't care. They would much rather losing the earnest money deposit than going in, buying the property, and then find out that the construction cost is way too high. So this is one of the reasons why we are not building enough housing units and fulfilling our supply and demand. And here is our inflation rate. Every month for the last, I don't know how many months now, five months, 6 months, we've been talking about increased inflation rate. This is the highest in 40 years, highs in 40 years. Again, we're the highest in 40 years. Now we're reaching 8.5% for March in terms of the inflation rate. The Fed official said that it's fantasy to think modest rate rises will tame inflation. This is by James Bullard. He thinks rates may still need to rise 300 basis points in order to tame it. He backs a half-point hike in May. They were talking about there's probably going to be 6 to 8 rate hike this year, and the total it could be up to 300 basis point. That's 3% increase. Let me go into a little bit more about the commercial real estate market stats as well, because that is the rates have an effect to the cap rate, right? The valuation of the property as well. If we look at 2011 Q1 to 2021 Q1, as you see that for multifamily, the vacancy rate has been coming down. It was elevated in about 2020, but really generally it has come down to 5% vacancy rate only. And for office, it has gone up in 2011. That was one of the biggest recessions, second largest recession in history, right? And it now has gone back up to about 12.3% in terms of vacancy rate. And industrial is doing so well. I'm sure, Max, when you do loan for industrial properties, do you have a lot of demands for industrial property loan right now?
Absolutely. There's a lot of demand for industrial property in the Bay Area in general. There's very low, and it's a lot like the residential market in the Bay Area. A lot of demand, very low inventory.
That is so interesting. You're right. It's like if you look at commercial side, industrial and multifamily, they are very similar to the residential side, the housing market, but not office. Retail is getting better, but office was really, really slow. Retail is actually improving to 4.5%. And we definitely hear a lot more people coming out to say they want to lease again, and they have more confidence to be out there, have a storefront, and then do their business. And as for the asking rent for apartment, it actually had gone up 11.1%. While office went up only 0.7%. And as you know, is still, of course, heavily relying on people going back to work, right? And if companies saying like, you don't need to go back to work anymore, of course, that market is going to shrink. But most of the companies do require people to come back to work at least a few days a week. And industrial, their asking rents has gone up to 10.6% and retail has gone up 3.9%. As for the sales price year-over-year percentage change for apartment has gone up 10.5%. And one of the main reasons why apartment has gone up 10.5% is also because of the cap rate has been so low. And as for office, still gone up 2.4%, industrial 15%, and retail at 5.1%. Now, when we look at cap rates, as you see that in 2011, it was 6.6% on average, but came down to 5.2%. Well, this is nationwide, by the way. This is not the Bay Area cap rate. I know some people was like, no, there's no way it's 5.2 over here. I agree, but a lot of areas in the nation, they're actually about 6% cap rate right now too. Office, their cap rate is around 7%, industrial at 6.3%, and retail at 6.9%. I thought this one is pretty interesting. It's from CBRE Research, their cap rate survey. As of March 2022, their report, looking at the sales volume 4-quarter rolling, the gold line is representing multifamily. The multifamily sector saw the biggest increase, accounting for nearly half of all sales volume in 2021, according to Real Capital Analytics. I think a lot of people are gonna say like, but we don't really see an inventory right now, because a lot of these multifamily sales is done off market, believe it or not. Not every multifamily seller requests their property to be placed on the market. A lot of times these are being conducted off market. That's why you see the inventory is really, really low on market, but there are a lot of transactions are being done off market. And as for the cap rates here versus bond yield, you see that the cap rate has been coming down quite drastically. However, they expect the yield on the 10-year treasury to increase to 2.3%, a level that will maintain a healthy spread relative to real estate cap rates. And property market fundamentals, which are driving returns, will be underpinned by strong economic growth. We're going to talk a little bit about the economic growth later too, because I think a lot of people kept thinking like, it doesn't sound like we're going to have any economic growth, but we can talk a little bit about that as well later. But they do anticipate that investors will continue to look to real estate for both relatively attractive returns and an inflation hedge. Interest rate hikes has been a really huge topic these days. Every month I've been using Wells Fargo's interest rate. Back in February, the high balance loan in Santa Clara County interest rate was 3.75%. And if you look back today for high balance conforming 30 years is 4.875%, and that has gone up 1.125. And look at this jumbo 30 years. In February it was 3.375, and then today, as of today, is 4.125, went up only 0.75%. So it is a little bit cheaper to do the jumbo loan compared to the conforming loan. Just looking at the rates historically, I think back in January, I did ask the audience about like, do you know what is the highest interest rate, or what year was it? We had the highest interest rate. It was in the 80s, right? The interest rate has gone up like 18% at the time. I remember in 2014, 13, we kept saying like, this is a historical low. That was about 4%. And then of course, 2020, it came down to like high twos, low threes. And that was amazing. A lot of people feel like that's literally free money. But now it's going back to about 4%. It is still really low historically, but I know we're just so spoiled now by that 2 and 3%, and seeing 4 and 5, we just want to cry. Like when I first started investing, like I mentioned earlier, I paid 7% for my loan. And this is the projections made from Freddie Mac, Fannie Mae, Mortgage Bankers Association, and National Association of Realtors. We kept telling everybody is that even their projections change from time to time. Every single month, I try to track as much as possible. So right now they have added 2023 1Q and 2023 2Q number. I feel like Mortgage Bankers Association, they are the closest to the reality. Is they're already at about 4.4% for 3Q 2022, while the remaining agencies, they were still in their threes. But as I just pointed out to you guys, it's already over 4%. So even these agencies' projections, they can be off. But I just want to share this with everyone that the projection is still trending upwards in the next 4 quarters or so. Here is a very interesting slide to show everybody, is that what is the impact of rising rates on housing changes when mortgage rate rise by just by about more than 1%. So if you look at historically, like again, we have to keep bringing back the history, right? Because like you said, people just don't remember, and we're not being shown this historical data all the time. So that's why people kind of relying on watching YouTube and see what people are saying. The historical data here is that from January 1996 to September 1996, for 8 months, the interest rate had gone up about 1.2%, and they landed at about 8.23%. But at that time, home prices gone up 2%, despite home sales volume went down 2%. 1998 to 2000, they had like 19 months interest rate hike, and it went up about 1.81% to 8.52%, and the home prices have gone up 13%, despite again a down in home sales volume. And then 2003, 2004, 12 months, went up to 6.29%. Home prices again had gone up 13%, and the sales volume had gone up 2%. And they had about average, this is more normal month, 5 months supply or inventory on the market at that time. And then 2005, 2006, again, for 13 months straight, went up 1.18% to 6.76%. Home price went up again, although home sales came down 14%. And then 2012 to 2013 went about 4.46%. Home price went up 11%. Home sales volume came down 2%, with about 4.8 months inventory nationwide. This is data provided by Freddie Mac. So what's the point of this slide? I mean, it's kind of like, even though the rate go up, historically saying, doesn't really have a direct tie to like a home price is going to crash because of the interest rate. So I know, again, there's so many people out there saying that because of the interest rate, the housing market is going to crash. We just don't believe that the home price is going to crash. It's going to go up by single digit only. Now, if we look at the month of supply now, even though we do have a lot more months of inventory in the Bay Area. So we used to have 1.3 to less than 1 month supply on the market. Now we have 2.1, basically about 2 months supply. So good news is that I've shown you earlier in terms of our offers, you have more inventory, you have a little bit less buyers. So you can actually have a high chance of winning a property now. I know it was so frustrating. You make 10 offers and you don't get anything accepted, but now you probably have a little bit more inventory to look at. And now look back to 2008, we had 14 months of inventory, and we have gone down to less than one, but then now we are about 2 months of inventory at this time. So Freddie Mac, what they're saying is that history suggests that when interest rate rise, there is an initial bump in home prices and many move quickly to buy a home before rates increase further, which is what we're seeing now. In the beginning of the year, everybody was expecting the interest rate is going to go up. That's why we had a really, really crazy first 3 months. But after that period, home prices slow. Freddie Mac analysis showed that a 1% increase in mortgage rate results in home price appreciation that's 4 percentage points lower. For instance, a 1% increase in mortgage rate would change home price growth from 11% to 7%. So I think, again, I think we have made our point pretty clear. In summary, that I think we do have economic growth still, 1.7 million jobs increase in 2022. We have very strong unemployment rate of only 3.6%. Retail sales actually rose 16% year over year. Earning growth, we actually went up 5.6%, and then we have very healthy vacancy rates in multifamily, retail, industrial. Asking rents for multifamily, industrial surpassed the inflation rate. Although the risk is that the supply chain is still an issue throughout 2022. Inflation is 8.5%, may go higher until, like, of course, now the Fed rate is increasing. Maybe we can start slowing the inflation. Construction continues to slow down due to increase in costs, which will affect the supply of housing. And we're expecting Fed rates to have aggressive rate hikes this year, potentially 2.5% or more this year. And then the month of inventory is increasing as well. Thank you so much for watching our YouTube channel. And don't forget to subscribe to our channel, like our videos, make some comments, because we're going to keep you posted on the most updated real estate news, housing market data, and also real estate tips and advice from all over the real estate industry. So thank you so much for watching, and I'll see you next time.